Let's bring in our panel. Joining us now is Wilmington Trust Head of Investment Strategy Megan Hsu and Unlimited Funds CEO Bob Elliott. Happy Friday, guys. Bob, you're long energy, short tech, so this week worked out according to plan for you. You also say to stay invested. So if you're an investor out there, retail investor, how do you manage to both take advantage of opportunities that you see and also stay invested?
Well, I think the main question is, do you have the sort of diversification of your portfolio that's necessary to actually weather these sort of dynamics? If you look at today, what do we have? We got stocks down, bonds down, gold up, and oil up. That's about the worst possible scenario for a traditional 60-40 investor. So those investors are going to have to look for other opportunities. Is it going into energy stocks? Is it buying the commodities directly, adding a little gold to the portfolio? You do that and you're in a lot better situation.
Which one?
All of them, right?
Okay.
Build that diversification, find those other opportunities. Going to put you in a lot better position to navigate what is likely to be a pretty challenging time for the 60-40 portfolio coming up.
Megan, you still like fixed income, relatively speaking, versus equities. How did this week play out as expected for you? And how does inflation look as a factor for you?
Yeah, I'll start with your second question first, John. I think inflation continues to be very important. And as we're looking at the outlook going forward, this week we got data that inflation might, at the headline level, be showing some signs of stickiness. And it's really that final sort of 10 yards, if you will, that we need to see if we can make. Core CPI, though, is approaching the Fed's target. That is very encouraging. And I think I'm actually much less pessimistic on the 60-40 portfolio because while I think we're probably in a bit of a churn period here for equities, I mean, you've got the S&P 500 at 19 times, basically, and projecting about 12% earnings growth next year. We think that's a little aggressive, especially given our relatively optimistic outlook for the economy, but still seeing growth being much more muted than it has been over the past couple of years. But fixed income, this is probably a really good entry point. And we've been talking a lot. We've been overweight to fixed income, talking about possibly, leaning further into that because as we see rates pick up and the outlook going forward, real rates have probably gone a little bit too far on too much optimism about the economy. We think we're probably more a 2% trend growth rather than the Atlanta Fed telegraphing 5.5% GDP growth is way too aggressive.
Yeah. Okay. Well, I guess that's the flip side of bonds being down. Yields are up if you're planning to hold them for a while. Bob, what about IPOs? We got ARM yesterday, huge pop, down about 4.5% today, getting Instacart pretty soon, probably next week, et cetera. Is that an important factor in this market? Can you still stay short tech if these IPOs continue to work out?
Well, I think the IPOs just give you a sense as to how much desired issuance there is in the market. How many companies have, the IPO market was frozen. They're looking to come into the market. They need to get that issuance to get, out of the private market. All of that possible supply sits there at a time when, the valuations are elevated, relative to, you're looking at, 2x times on tech relative to energy in terms of valuation. So you got supply issues, you got valuation issues, and you got a long end that keeps creeping up, which, we might have forgotten about the fact that tech stocks are sensitive to the bond moves, but every once in a while, that's going to come back for those tech valuations.
Megan, is the pop dangerous? If you look at how IPOs have performed, aside from Mobileye, which Intel spun out a bit ago, they don't seem to hold a lot of those pops for very long. So if you were thinking about, getting into Instacart, other stuff that might be coming down the pike now, they just, raised their target price now that ARM did well. Would you do it?
Well, I'd be not as active in the IPO market as some are today. I think it is a good barometer of some improving sentiment. And we've really been whipsawed a little bit by investor sentiment, especially on the retail side. It was pretty euphoric early in the summer, and it's really tanked off. And we started to see maybe some better longer-term indicators because obviously too much optimism in the market's not a good thing. But I think, we've had quite a bit of quiet period for IPOs. So to see them coming back, I think is a good thing. And to see a little bit of a pop, I think is a signal that maybe investors are looking to get back into the market. I mean, you have more than $5.6 billion in money market assets today. That is basically a lot of dry powder for the long-term investor who's looking out at return prospects 12 months ahead.